So for me, it's about getting the right team involved from the start. That means getting your lawyers involved, accountants, corporate finance advisors, and the important thing with an FS business is making sure those advisors have the requisite specialist knowledge for this type of transaction. You need advisors who understand the FCA, PRA and how they operate, who understand the market trends and can effectively spot issues before they become problems. Getting that team engaged early on is really important as well. That will help you avoid delays later on and preempt any problems that come up. So it really depends on who's investing and how much you're investing. The FCA, for example, will have various controller thresholds, whether that's at the 10% level, 20%, 30%, 50%. So understanding early on how much you're willing to commit and invest in a business and how you're going to structure that investment will really then determine what type of consent you need from the FCA itself. The problem is getting this type of thing wrong can attract some criminal liability. So it goes back to the point I made earlier about getting your advisors in early who understand this and can advise you correctly. The other thing to think about from the FCA perspective is who you may be investing with, for example. So if you're investing alongside other people, but you're going to be voting and controlling that interest in the same way, for example, you may be deemed to be concert parties and therefore need to look at the investment thresholds as a whole rather than on an individual basis. One example there is if you're part of a management team, for example. That is where if you all agree to vote in a particular way or grant someone a power of attorney to vote your shares on your behalf as a group of managers, that can mean that actually you're deemed to be concert parties for the purposes of the FCA rules. But as always, getting the right advice on the structure and getting advice on how you draft these documents is key. So that really depends, again, on how you're going to structure the investment and ultimately what type of role you might play post-completion. One of the things people forget about is that these change of controller applications look at the sort of direct ownership and control and also the indirect. So you may be an individual based outside of the UK holding all of the shares in a holding company where the regulated business is actually sitting somewhere in the UK. In that circumstance, the FCA is interested in who ultimately controls the business from an individual perspective. So yes, in that example, you would be vetted and need to be approved by the FCA as a controller. One other thing that really matters is the type of role you might be playing in the transaction post-investment. So if, for example, you're a director of the regulated business, you may also need to be approved as a senior manager by the FCA, and that can again take some time and effort to put in place. So it goes back to an earlier point, getting early engagement at the beginning of a transaction really is key. So as with most transactions, an investor will want to undertake its own due diligence on a range of aspects. From a regulator perspective in particular though, what an investor will want to look at is what are the permissions that the regulated entity can actually undertake. That can take some time to work out, but one of the pitfalls we often see is that there's sometimes a difference between the permissions a company might have versus the activities that the management team actually undertake on a day-to-day basis. So it is key to understand what permissions the entity has and in practice, what are they actually doing. Again, this is an area where getting specialist consultants to review is key. They can go in and have a look at the different compliance manuals, they'll have a look at the complaints risk, etc. But ultimately, when it comes to regulatory issues, yes, some of the issues can be rectified by putting in place new compliance manuals or putting in place additional policies or controls to ensure things don't go wrong in the future. Sometimes the issues that arise actually are so large that they create a reputational issue. And it's that type of risk which is much harder to contractually protect for under your sale transaction, because ultimately an indemnity isn't always going to be the right recourse for that type of risk. Yes, regulatory capital. Sometimes it's often something that's overlooked on a transaction. But from an investor's perspective, understanding how your equity or your debt investment is going to be treated from a regulatory capital perspective is key, because it will impact the amount you might get back from your investment. It will impact your exit strategy, and ultimately could impact the growth projections of your investment itself. One thing to think about from a regulatory capital perspective when you're investing is, what is the regulatory capital headroom? If a company is operating at its minimal or near its minimal regulatory capital levels, that might indicate that actually the business is under stress, or indeed that it's got a limited ability to grow in the future. So something to watch out for. Investors should also be wary that a company's regulatory capital requirements may change over time. And it may be the FCA that requires further capital to be put into the business. So when investing, you want to be very wary that you know exactly when you might be required to put in extra capital, and if further regulatory capital is required, being very clear as to whether or not you are obliged to do that at the relevant time.